Before we get started, I'd like to introduce you to David Broadbent, our incoming CFO, to say a couple of words.
Okay, thanks Chris. Hello everybody. So for those of you that don't know me, my name is David Broadbent. I joined Fairpoint having previously spent the last 16 years at a company called International Personal Finance PLC. For about 10 years of that time I was the finance director through to the end of 2013, and for the subsequent 2 years I was chief commercial officer. So in terms of joining Fairpoint, probably worth sharing what my motivations were. Probably three key themes. First of all, I like the people at Fairpoint, they're very down to earth. Secondly, I thought that the board had done a really good job repositioning Fairpoint across from being a pure play in terms of debt services and the transition towards legal services. And thirdly, I can confirm that I'm very excited about the opportunities in the legal services arena to build a large-scale, consumer-focused organisation.
Thanks, Dave. Okay, so I'm going to jump straight into the presentation. We start off with the financial highlights, which are on the screen for you to be able to read. I'm sure over the last couple of days you'll have an opportunity to digest them. So I'll just pull out the highlights. Revenues were up 24% in the period against flat profits as we transitioned the business more towards legal services, where the growth opportunities are there, albeit the products tend to have a lower margin along with them. There are two areas that I want to pick up on before we get into the main body of the presentation, which have been the notable headwinds that we've had during this period. The first of those relates to debt management, and we took the decision in July to exit the debt management segment of our business. The reason, prime reason for that is that as we saw clarification on regulation in this sector and applied that to the operating model, we could see that the economics of the model had deteriorated quite substantially, in particular with customer retention rates falling and the cost of serving those customers going up. So we've set about addressing those issues very quickly. We decided to exit the market, and we are well on with those plans. We've undertaken consultation with affected employees, and we have a transition plan which will take us out of the market by January of next year at the latest, whilst we move our customers towards free-to-consumer alternative product solutions. Needless to say, this has had an impact on the general financial profile from debt management, which has made an important contribution to the group over the recent history, but certainly in terms of our forward view, we would see that as reversing as we look forward, and so have taken the decision to come out of the market. The second area that's worth highlighting is conveyancing. The conveyancing area represents around about 8% of our overall business volumes or revenues, and we saw the start of the year actually coming through a fairly positive period where like-for-like volumes in the market compared to prior year were up in Q1, but then in the run-up to Brexit votes, volumes started to become subdued, which had an impact on our conveyancing volumes, although at that time we felt it was more a gentle slowdown in anticipation of Brexit with recovery to follow thereafter. Unfortunately, given the vote went to leave, we've seen that have a much more marked impact on the housing market and in turn conveyancing, particularly in the southeast of the country, which is where our main distribution channel exists. And you can see on the graph on the chart just the degree to which volumes have fallen, and in particular relative to last year. So our view now on the market is that this will probably persist through the second half of the year. Hopefully we will see things recover in future years. We have very few data points to be able to take a forward view on this market, so we're being relatively cautious in that we're retaining our staff during this period, particularly because we are based in the southeast where we need more conveyancers with high levels of skill who are used to doing leasehold transactions, for example, and then we will take another review of the position come the end of November period. as we plan for next year. Strategically, however, we are making some great progress on our migration towards more of a legal services oriented business. You can see from the chart in front of you that year on year revenues in legal services grew over 90%, mainly due to the acquisition activity of, in particular, the former Coleman's business, but we did also see 4% like-for-like organic growth coming through in that business. It's now quite clearly the predominant product line that we offer, and it offers great growth potential to the consumer, to the business, because we are now operating in a £10 billion consumer legal services market space. So clearly significant headroom for growth and achieving our goal of becoming a top 5 consumer legal services firm in the near term. In order to achieve that, we're going to be deploying the target operating model which we described to you last time round. So 3 components, 3 strategic themes if you like to that model. Part 1 around marketing and distribution, migrating to a single brand using an innovative marketing campaign which we have launched into the marketplace already. Part 2 around broadening our product portfolio, so we have a good mix of fast to cash products and slower to cash but higher margin products, and using transparent pricing structures to be able to attract consumers. And then thirdly, the area which has been a key focus for us over the last 12 months or so has been the migration towards a single common operating platform. We now have 80% of our caseload migrated onto that single platform, and that enables us to continue with some level of acquisition activity, generally selective product markets that we don't have a position in at the moment. But it's fair to say that the heavy lifting on acquisition is now complete, and the main focus we have for the business is now on the organic agenda. And to that end, we launched a social media driven marketing campaign last time round. That's starting to get some great traction. The social media campaign is attracting national airtime coverage. We've been featured on most of the major radio channels. You can see some illustrations of our lawyers on national TV with BBC Breakfast and then Good Morning Britain, commentating on breaking stories as they come through, things such as term time holidays, the implications of Brexit on immigration, through to celebrity stories such as Jose Mourinho and Eva employment dispute. What that's showing us at the moment is that we're seeing some of our lead indicators, i.e. of more brand search traffic coming onto our website, which tends to convert at a higher level. And we're also seeing better responses from our fixed fee product offers. So some early signs of good progress on the marketing side. In terms of the balanced product portfolio, you can see how that's changed between the first half of 2015 to the first half of 2016, with much more balance starting to come through into the product lines, giving us a bit more resilience as we see the ups and downs of various markets play out in future. And then finally on integration, which I described briefly earlier, we have a large number of different areas that we've made progress on, summarised into progress on our technology, people and the processes that we're using to productionise the cases that we run on our legal platforms. So I'm now going to hand over to John Gittins, who's going to take you through the financial results for the first half.
Thank you, Chris, and good afternoon, everybody. If we could start on slide 14 with the financial highlights. And as Chris said right at the start, revenues increased by 24% to 28.3 million in the half, and that's driven by the strong contribution at the top line from the legal services business. Adjusted pre-tax profit was broadly flat at 4 million, and that's adjusted for the amortisation of acquired intangibles, the unwinding of discount on contingent consideration and exceptional items. Net finance costs increased by 300,000 to £400,000 as a result of the increased borrowings in the period. The effective tax rate was 20%, the same as last time. EPS fell slightly by 5% as a result of share issues over the last 12 months. and we have held the interim dividend at 2.45 pence per share. Moving to the revenue bridge, you'll see that collectively the debt solutions and claims management activities reduced revenues by 4.7 million, but were more than compensated by a £10.1 million increase in legal services revenues, resulting in the reported 28.3 million. And on the next slide, a similar format, a £1.4 million reduction in adjusted pre-tax from the debt solutions activities was compensated by a 1.6 million increase in legal services pre-tax profits, with a small £300,000 increase in finance costs, resulting in the 4 million reported result. So page 17 is just a spotlight on the legal services segment, which is now more than 3/4 of the group's activities. And as we've previously said, revenues increased to 21.5 million in the period. That's an increase of 90% compared to the same period last year. And contained within that organic growth of around 4%. In addition, in May 2016, we acquired a small market-leading practice specialising in child abuse cases called Abney Garsden. That brought along around about 400 cases, and we're very pleased with the early indications from that acquisition. On the right-hand side, you'll see adjusted pre-tax increased to 3.1 million. We've made good progress on integration, both physically and in systems and marketing, and I'm pleased to report that margins have progressed during the period from 13% to 14% at a net profit level. On page 18, a few words on operating cash flow performance, which was 1.5 million in the period, or 1.9 million before exceptional items, compared to 4.9 million the period before. So a couple of working capital movements occurred in the first half, which we don't expect to recur in the second half. Firstly, there was some working capital movements relating to the reduction in debt solutions activity of around about 1.4 million, and an increase in work in progress lockup to 118 days compared to 104 days at the start of the period, due to a change in mix towards more complex cases, and also due to the disruption caused by the replatforming onto one case management system, which, as Chris reported, is 80% complete by the end of the period. Investing activities of 1.4 million included around about £500,000 of investment in case management platforms, around about £500,000 in finance systems, and the remainder in IT infrastructure. And during the first half, we spent 1.9 million in final dividends relating to 2015. On page 19, the net debt position at the period end was 15.6 million compared to 13.6 million at the start of the period. We have a long-term committed line with Allied Irish Bank of around about 25 million, which gave us cash resources and unused facilities of 8.6 million at the period end, and leverage was 1.3 times compared to 1.1 times at the start of the period. Finally, some financial trends for the second half on page 20. We expect legal services to focus on continued completion of the integration. We're almost there, we're at 20% to complete. Organic growth and some further acquisitions of both partnerships and indeed work in progress deals. For DMP, we expect the continued wind down of the business, which will be complete by January 2017. And for IVA, our focus will be on cash management. So overall, we expect the half two profit performance to be similar to the half one. Just some other cash and profit related items. Up to 6.5 million of contingent consideration is likely to be paid during the second half, half of which will be settled in shares and half of which will be in cash. The tax rate we expect to remain at 20% for the full year. The amortisation of acquired intangibles will be around about 5 million. And as a result of the wind down of the DMP activities, there will be a non-cash 5.5 million impairment of intangible assets and goodwill relating to our DMP business, and 2.5 million of exceptional restructuring costs, around about half of which will be incurred in cash in 2016. I'll now hand back to Chris.
Thanks, John. Okay, so in order to look at the activities which we're going to be undertaking in the second half, I thought a useful starting point would be to reconsider the market fundamentals that we have in the legal business, which represents a £10 billion consumer legal services marketplace. And the good news around this market is that the initial hypothesis we had, which led us to want to move into this space, continues to hold true, in that this market has very limited concentration. It has 10,000 legal firms, most of whom are small organisations, 94% less than 12 people, 74% less than 2 people operations. So it's dominated by subscale firms with limited incentive to change, i.e. to move away from a traditional time on the clock type basis of charging to a fixed fee type method of charging. And over the 2 years that we've been involved in the market, there's been limited and minimal change in that competitive landscape. And so we still believe that by leveraging our price transparency, better value and choice across a broader range of products, we will be able to unlock the latent demand that exists in the marketplace and create a structural competitive advantage. And to that end, we'll continue with the themes, first of all starting with the front end of the business, the new business opportunity. So we talked about the progress that we've made to date on the advertising and media, the initial inquiry handling, and we also highlighted the migration of the platform onto a single case management system where we undertake our case inceptions and the supervision of our cases. The second period of this year will start to broaden the product range that we're using our new advertising campaign to feature. It'll be about putting more capacity into our helpline, but importantly a highlight area for us will be around ensuring that we can better qualify the cases that come into us at their early stage before they have to be dealt with by a fee earner. This is where the operational leverage really exists in the business, because only around 10% of case inquiries will result in a new piece of work that a fee earner will take on. So clearly the better we can narrow the funnel at the early stages of a case, the better the operational performance will be in the business. So that's the first area of focus. The second area on this rather busy slide is just to give a breakdown of the various products that we have within our suite. We now have a very broad portfolio. Each of the products that we operate has a different profile of cash and of margin. Generally speaking, with the faster to cash products having lower margins, compensated for by the slower to cash products having higher margins. And what we're aiming to do here is fill in some of the gaps we have in our product range with selected acquisitions, but more importantly broaden the growth of our product set through our organic activity. So we end up with greater product diversity leading to better business resilience. Finally, in terms of the single platform that we have in place, the first period has resulted in largely the completion of the integration onto a single platform. The next areas will focus on a continuous improvement program of taking those systems and seeing how we can utilize them more effectively, either in the ways we work with a system or by reconfiguring certain elements of them to improve, for example, the customer journey or our own productivity levels internally. And on the slide there are some examples of the areas that we'll be focusing on. So in summary, we're now operating largely in the legal services marketplace, which we see as a large and fragmented marketplace presenting a substantial growth opportunity. The market fundamentals which led us to invest in that marketplace in the first place are still there, and we believe we're well on the road to creating a structural competitive advantage to realise the benefits of that position. We're able to do that because we've made substantial progress on integration, and we're on track to complete that by the end of the year. We have had headwinds in both the conveyancing and the debt management area, but that doesn't take away from the progress that we've made on our midterm journey of establishing a competitive advantage in the legal marketplace. In terms of looking at the second half, we see the half two performance being very similar to that achieved in half one, and that gives us the confidence to maintain our interim dividend and reflects the progress that we expect to continue to make in the legal services marketplace.
Great, thank you very much, gentlemen, very clear. We have a number of questions, so I shall dive straight into them. A number of them relate to the single platform, and Brian is curious, particularly for you, Chris, presumably you have prior experience in your insurance days in merging operations onto a single platform.
Yeah, that's right. I mean, I think what we have done here is we've selected a platform called Proclaim. It's a platform that ultimately is owned by the Capita Group. So it's a vendor platform which has a range of upgrades and improvements as part of the ongoing license costs. In terms of the approach we've taken here, part one of our approach has been to make sure that we plug into the better operating performance we saw where the Proclaim platform was used compared to the historic legacy platform. And so we have now largely completed that with 80% of our caseload moved across. We haven't bogged down that process by trying to make improvements as we've gone along. It's simply been a case of plugging into the higher margin and getting that process completed as quick as possible. Now we're largely through the other end of that. There will still be more to come, and I think John outlined that our margin even in this period has increased from 13 to 14%, and we can see that we will be able to make further progress on that once the change and migration process is complete.
Yeah, and following on from that, Vincent was touching on similar points. Have you experienced any significant problems? Presumably not if you've now reached 80% towards conclusion. What would be the projected lifespan of this platform? Will it last for many years? And presumably there are very good margin implications going forward if you have in effect sunk most of your capex into creating the platform already.
Yeah, so in terms of the first part of the question, whenever you go through a migration integration of this scale, it tends to be a difficult process because you're going through a huge amount of change and asking at least half of the business to change the way they've generally interacted with a system and get re-familiar with a new one. In my experience, the best thing to do is to get through that process as fast as you can, and we have largely completed that. So, and I think coming out the other end, the key here is going to be about putting the further development activity on top of that to make sure we really can create that edge in the marketplace. Having moved over to the new platform, as I said, we do expect for margin improvements to come through because we will be able to adapt that system, and we expect the lifespan of the system to be relatively long in that it is a third-party vendor platform which we've chosen to purchase, which comes on a license fee basis with upgrades as it moves along. And the reason we went down that route rather than build a bespoke system is exactly because of the flexibility that it provides.
Right, thank you. Let's move on to marketing, which has been very important in driving volume so far and will presumably continue that way. Could you just update Richard whether you have used the same agency or indeed the same agencies over the last 12-month period, and roughly how much are you committing in marketing spend?
Right, okay, so in terms of the agencies, we have a relatively flexible roster, and we are using an agency driven model rather than an in-house creative capability, quite simply because we're operating in a relatively dynamic space, merging together technology, social media and so forth. The degree to which we stick with one agency or use others will be a function of the skills that are required to complete that task and stay ahead of the competition as we go forward. So that will continue to be something which is flexible for us as we move forward.
Okay. In terms of customer satisfaction on the legal services side, Paul has noticed one or two less than flattering reviews on sites, which of course you can usually find if you look hard enough on the internet. Could you say which legal bodies you regard as opinion leaders, and indeed how you liaise and take feedback from your own clients about satisfaction?
Yeah, sure. So there are a number of different sources, and it's fair to say that this is an area which is relatively immature, if you like. But in terms of the way we operate, there are some generic measures that are used in the legal space, which generally look at the competence and capability of the lawyers and their performance and result in a top 500 legal list. And across Simpson Miller and the former Coleman's business, we tend to score very well with regard to those. In addition to that, from an internet perspective, we use, for example, Trustpilot and Review Centre in order that we're capturing feedback on a real-time basis, and we can start to iterate on that feedback and make sure that if something has gone wrong, we put it right, but hopefully we're generally on the right lines. The vast majority of the feedback that we receive is very positive, actually, and we're quite pleased with the progress that we're making to date, but we'd never be complacent, and we're always looking at the ways we can improve further. I think the principal thing we're trying to create in the legal business is a service company that happens to do law, and we are on a journey in that regard, and what you will see us introduce is the more mature customer satisfaction devices. Some of you may well have come across the notion of net promoter scores and top box scores and so forth, which is where our attention will start to move to in order to continually improve the service customers have from us.
Thank you. All right, a couple of financial questions. Not sure who's going to take them going forward, but maybe John, for you, historically operating cash flow at Fairpoint has tended to follow operating profits. You highlighted some of the problems or the one-off headwinds in terms of work in progress in this half. Do you see more of a reversion back to historical trends over the medium term going forward?
I think as we increase the proportion of the group's business into legal services, there will be inevitably require an investment, a further investment in working capital, which makes the previous record the group has delivered, which has been very strong, of converting more than 100% of operating cash into profits. That's going to be difficult to achieve depending on our growth aspirations in legal services. But as I said during the presentation, I confidently predict that the conversion at the moment, which was in the first half 57%, will be bettered, significantly improved in the second half. And our target would be to achieve more towards 75-80% conversion, but that will, as I've said, depend on our growth aspirations in legal services.
Thank you very much. Dividends. Now the group is focused on legal services and given some hopefully positive margin implications. Chris, could you outline on a medium-term view, 3 to 5 years, how you will be looking at dividend cover during that period?
Well, we do look at dividend cover, but it's not the sole criteria that we look at when we're establishing what level of dividend that we put out. That tends to be a feature of both dividend cover, dividend yield, opportunities we have for acquisition, and other places we might look to deploy cash. But what I can say is that we're very conscious of the fact that we have a high dividend yield, and we have a number of investors that are invested for income in the business. We're very clear that when we put a dividend out, we expect to be able to go in one direction, which is an upwards direction on it, and and that's the way we look at our dividends. So in terms of further steps, we will consider that at each review point as to when it's appropriate to move back into a progressive mode. Quite clearly, we're coming out the other end of a very substantial transition for the business, from one which 2 years ago had no legal services to one which is now dominated by that product line. And through that journey, we have generally increased and at least held the dividend. And I see no reason why, with the plans that we have in place, that needs to be affected.
Right, and then final question comes from Ashraf, just in terms of the next few months. It does sound to him as if the pace of solicitor and legal purchases is not going to be the overall driver of the group. There's a lot of organic focus, but will the final handover of the debt management operations preclude you from doing transactions in the next 6 months, or is that now sufficiently well underway that you can take opportunities when they come along?
Yeah, I think our position has always been that we have set out our strategy and our organic agenda. If an acquisition helps us get from A to B quicker, then it is something we'll consider and won't hesitate to utilise. In terms of the movement into legal services, the big steps to establish our platform, our product set, have been completed. So the kind of acquisitions we'll focus on going forward will be small infill acquisitions or work in progress back book deals for the main part. And we certainly have enough cash resources to be able to do those kind of transactions, which tend to be oriented towards contingent fee payments, subject to various performance conditions.